All right. Hello there, and welcome everyone to this week's edition of Self-Wealth Live, the technical analysis edition. This is after a week off, after we've both had a break and had a week off in the financial year. Jace, how was your week off?
It was good, Rog. I enjoyed some sunshine up in Queensland, so that was nice. Now we're back cooling down again very quickly back in Sydney. So yeah, enjoyed the time away in the sun.
That's fantastic to hear. I tell you what's not cooling down. While we were away, the market, especially the last few days, the markets have hit all-time highs. So that's certainly not cooling down and broken right through there, right? But we'll get into that very soon.
Yeah, so lots of really interesting things to talk about in that respect. There's, as you say, a lot of changes in the market. So yeah, I think we've got some interesting things to go through.
Yeah, if I looked at my portfolio, while I actually had the week off last week as well, and if I look at my portfolio, I only looked at it once every day, and every day it was up quite a bit, and I'm like, oh wow, this is amazing. It's what we talked about after all these weeks, saying we're still pretty bullish, but we're not to know this obviously in hindsight. We're just lucky that it's going that way, right? So it's good to see it. Right?
We position ourselves. It's like we put ourselves in the position luck plays a role in all sorts of things, but it's like we don't have a good portfolio simply due to the luck. It's due to luck can have a little influence whether we buy stock A or stock B, but over time it's your process which is going to determine your success. And we position our portfolios in a way to take advantage of certain conditions should they occur. And that's kind of how it works. So the way we've been talking over the last few months has been the market's been range bound, but if we use wide trailing stops, staying in our stocks which have been doing well, give them room to consolidate, then we're in a position to benefit should the market turn higher. That's what it's done in the last week. So it's and you remove yourself from the field of trouble when things break down by having those exit points as well. So it all comes down to process. Process doesn't mean you're going to make money all the time, but when all the planets line up and everything starts working, as you found last week, you can have some really strong periods, and then when things take a turn to the downside, it's about having the risk management so you don't then ride them all the way back down. So we're trying to let upside run, then we're trying to contain downside when it comes. Play those sort of parameters, year in, year out, you tend to do well over time.
Yeah, we've had plenty of look. At the end of the day, we have plenty of feedback how much great great sort of advice, so to speak, general advice only. Once again, that we give clients and being able to understand these concepts, really, really important concepts. So that's why we keep on reiterating, even in the good times. A bit of a good time at the moment, but you never know. I'm sure we'll still have a show when we're going backwards, right? So hopefully,
and that's inevitable. Like the portfolio is making highs. It's great, but I don't get carried away when that's happening, because I know there's going to be another period where we're going to go through 6 to 12 months of pullbacks and sideways, and it's and that's not so much fun. But if you don't get too carried away when you're doing well, then you shouldn't get too downbeat when things are struggling. It's it's like the pendulum. The more it swings to one side, the more it's going to swing back. So you're just trying to moderate those emotions so you don't get too excitable when you have a good week. Yeah, that's good. But if you get too excited, well, then you're going to be like head in your hands when you have when you have one of those down weeks, and they're inevitable, unavoidable if you want to be in the stock market. So every equity high, always keep in the back of your mind, there's another drawdown in the makings. It's just we just don't know when. It could be months away. It could be next week, and we don't know the duration. And you will get those ones that drag on for a year or so. It's like it's part of the game.
Yeah, exactly. Well, it's just pierced through. We just don't know whether it's gonna come right back right now. Obviously, but I am excited that we're back. All right, so I'm going to contain my excitement now that you
That's something to be excited about.
You pull me back. I'm excited that we're back. All right. So, welcome everyone who's joining us today. Obviously, as well. Before we keep on going here, let's please bring up our disclaimers, if that's okay, Jason. Thank you.
Quick word about that. Yes, so everything is general commentary only, no personal advice. Let me just put up that disclaimer, and that just goes through all that. So I'm also not part of Self Wealth. I'm Motion Traders, my business, so all my details are in the top section, licensing, all of that. And then Self Wealth's disclaimer is below that. Again, licensing, and both are all around general advice. And if you need personal advice, you've got to go and get that separately. That's not what this is all about.
Exactly. Yeah. All right. So let's move on. We've already got a couple of questions in there. For those of you who haven't joined us yet, what we're going to do today is a general, once again, session where we go through a market analysis of ASX, the US markets, and the Hong Kong markets, because that's what we offer here at Self Wealth in terms of what you can trade. Secondly, we'll go through any general questions, and then we'll have a look at tickers that you guys might find interesting, and we'll see what our thoughts are. They are just general thoughts as usual, right? General advice once again. So please do your own research and do your own due diligence whenever you're dealing with your own stocks and trades, right? So, all right, Jace, we've just talked about it. Let's have a look at the chart then. What does it look like?
Well, let's jump over to the ASX 200. So finally, it has happened. We have a breakout, and this comes after nearly 4 months of the market just tracking sideways, and we've also got an all-time high. So a few things going on. So this is across the All Ordinaries as well. So the ASX 200 and the All Ordinaries both at all-time highs. And we've been tracking this sideways consolidation since back in April, when we got what was then an all-time high. We started getting the makings of a pullback, and it's turned into this range. So we've been tracking it since April, and it's continually been. What's been interesting is that all the dips, basically all year, all the dips have found support. There's always been strong buying interest every time the markets come back towards the moving averages. So got the 50-day, the 100-day moving averages. Moving averages of those that medium-term duration, you often do see the market finding support around those, and that's been the case in recent months. And then this range has continued to contract over the last few months as well. And I think we might have spoken about this a couple of weeks ago. We also had a range within a range, and can just draw there this rectangular range which formed up over the last 4 weeks. So we had a lot of compression, a lot of contracting going on. And this is the thing with ranges. So these periods of dull and inactive trading often lead to periods of activity where then you get expansion of volume and the prices start to move. And this is when trends develop. And that's where we are at the moment with this the breakout. So we've got all this quiet, dull trading, and then you get the breakout, and look at that, you get all that movement. That's the way these things work. I think the play here is to go with this breakout, and we see where it takes us. Path of least resistance at this point is to the upside. What I think is really interesting here, Rog, is that it's interesting that we've got this breakout in stocks, and it really does defy the media coverage that we've had in general over the last year or so. So it really has been about a crisis and everything. So, from inflation to housing, and you name it, it's been a crisis and everything. So if you're just skimming the headlines or watching the first couple of stories on the news each night, you'd probably think, look, this last couple of years, or the last year or so, geez, it must have been a really bad time to be an investor. But you look at what the market's done in the last since the October lows, it's actually been quite a strong period. So this is the thing with news flow. We often get this. We often get these periods where the news feed and the price action are out of sync, and this has been very much the case in the last 6 or so months. And I think when that happens, my preference is very much it's about the price action. I'd rather follow the price action than try and reconcile everything with what I'm reading in the what I'm seeing in the news feed. So I'd rather back the trend, manage the risk around the trend losing its momentum, and rather than going, oh look, it doesn't sound good, I might stay out. I think the biggest risk is actually when we ignore price breakouts, like we had in the break above the moving averages back in December, led to a good period. We're getting a breakout now. We don't know how that's going to play out, but I think the biggest risk is when you ignore these breakouts, you make excuses saying, oh, look, it's gone up, but it's probably going to come back because of this and because of that. I think the risk when you do that is the market continues upwards without you. And there's always risk. You get false breaks. Some things don't play out, but we can always manage risk with simple strategies like a stop loss. So we've got a breakout now. If the breakout fails, we can have a stop loss back, maybe just back around the moving averages again. And so you can, that's what we were talking about before. It's about positioning the portfolio. So you're positioned for success, but if it doesn't play out, you've got a line of retreat. So you're giving yourself that, you're opening up that upside potential while containing the downside. And so of course, we're not going to get right all the time. There are going to be breaks that fail, but if we can minimize the damage when that happens, but then we maximize the upside when one of these breaks runs, that's how we can do well over time. Just getting a quick overview of all this, like you just compress this chart back. Like here's our COVID lows, big rally. Big rallies are often followed by big consolidations, which we got over an 18-month period. And now we've got a market which seems to be lifting out of this this large sideways pattern. So we've got a big rally into a large sideways pattern. Now it looks like it seems to be getting momentum to the upside again. So I think the play is, as I say, go with that breakout and see where it takes us. The other thing worth mentioning is all-time high. People often worry about all-time highs. They go, oh, look, the market's an all-time high. It's probably due for a fall. And at some point, an all-time high will be a lasting all-time high that could stand for a year or two, or in some cases, a decade. But a lot of the time, probably most of the time, all-time highs tend to cluster and lead to more all-time highs. And that's what a trend is. It's about increasing prices over a period of time. So, look, I think it's encouraging price action. I think it's good price action. You want to see where this goes. Want to be long, let profits run, wide trailing stops, manage risk.
Yeah. I look at it, that's great as always. Great to hear. Those sort of things never stop. Doesn't matter what you do, obviously. So, have we got the same case over in America? The same case over in America?
It's similar, but of course there's differences. But there's a lot of cross current in what or a lot of things which are similar. So just going over to the S&P 500, I think this has been a really significant week. Last week in particular, another all-time high for the S&P 500 on Monday before just pulling back later in the day. So the upward trend here remains firmly in place. So there's no surprises there. We've had a market which has pulled back to the moving averages a couple of times in the last month or two, and each time it's found that support kept rallying. So we've spoken about the upward trend, and the play with an upward trend is always, from my perspective anyway, it's like, let it go, let it run, try and stay on it, wide trailing stop. So all that's fine. I don't think that's the most significant event of the week, though. This isn't so much what I want to talk about. I'll show you what I think is really really important, what I think is really significant, I'm going to click over. So I've got the S&P 500 index here. So that's a market capitalization index. So the larger stocks have the most influence. There's 500 stocks. The top 5 in particular, big tech stocks, they've been doing all the running and really lifting the index. Whereas you go down through the other 495 odd stocks, a lot of those stocks haven't been doing very much. But you don't notice that when you look at the index. You just see the movement of the big ones have been driving this. Let's click over to an equal weight. So this is an S&P 500 equal weight ETF. So the bigger stock and the smaller stock have the same weighting. And what we've been talking about in recent weeks about this is we've had this non-confirmation where the S&P 500 has been making new high, whereas the equal weight has just been tracking sideways. And so this is an area we've focused on for a while. And what we have now is we have a breakout in the equal weight. So we're starting to see the equal weight lifting off its moving averages and breaking out above the recent highs, the highs for the last couple of months, breaking above the May high, and now within a whisker of the March high. So we're starting to see momentum come into the equal weight, which I think is really important, because really we've got this big compression range. You can see from the April high, you can see it's quite similar to the ASX 200 in that it takes on this triangle shape where it converges and the ranges get narrower. And then we had this range within a range. You can just see marked here in the blue shaded area. So we've seen the equal weight break out of this narrow range over the last 4 or 5 weeks, and it's also breaking out of this broader range, which has been taking shape from about April. So it's like a double break. And I think this is a significant event. I think what it shows us is that for the first time in months, we're starting to see signs of broad participation in the rally. That's one of the things. Well, that's been a big thing that's been missing. It's been those handful of big cap tech stocks doing all the heavy lifting, whereas you've got most of the stocks in the broader market, they just haven't been participating, hence this range. That could now be starting to change. I'll show you one other thing which I think is really interesting. This is the percentage of S&P 5 stocks above their 100-day moving average. It's quite a useful indicator just to get a gauge of what the broader population of stocks is doing generally. So it's been, whilst we've been getting this strength in the S&P 500, you can see the percentage of stocks above their 100-day moving average has been declining. Got down to only 42% of stocks being above their 100-day moving average only a couple of weeks ago. So that's been a point of probably vulnerability, or a point of something to be aware of and to manage risk around, that many stocks were breaking below their moving averages. And but now we've seen this turn in the last week, and now we've got a lot more stocks above their 100-day moving averages, which is great because that's a sign of broader participation. So I think that's an important thing. I think there's also potential now that we've got this swing around and this indicator. I think the potential there is for this to continue increasing. And if we see the number of stocks above their moving averages, above their 100-day moving average continue to increase, I think this flows through to the S&P 500 equal weight, which in turn flows through the S&P 500. So some important developments going on in participation. Just coming back to the S&P 500, I think the play here remains, and this has been the case since the S&P got above its moving averages back in November. I think it's quite a simple play of letting profits run, using a wide trailing stop, try and stay on this trend. It's a trend which remains in place. And I think the beauty of that trailing stop strategy is that it helps see off the consolidations that many stocks have been having. So just looking at the equal weight, wide trailing stop strategy, you can see off consolidations like this. And then if you get the breakouts, which we're getting now, then hopefully you're in those stocks and you can do well. And the other thing we've talked about is I think it's been a case, particularly in the last couple of months, for me, it's been focus on the components of the index rather than the index itself. Because as we've spoken about, just a handful of big tech stocks have done most of this rally. I'm happy to hold stocks which have run hard. I don't necessarily want to buy stocks that have run hard. I'd rather buy stocks which are rallying off their moving averages and breaking higher. I think we find those stocks amongst the broader population of the S&P 500. This is why I like to look at the components, not just the headline S&P 500. But overall, I think this is an encouraging sign. We're getting this breakout in the broader market.
Yeah, and Kirby actually just brought up the point that I was going to bring up. If this is sort of confirmed, and if you have a look at the Russell 2000 as well, that's also showing very bullish. Same sign, very bullish price action, right? That's just
This is something I was talking about in my strategy session on Friday, in that we had this gap higher in the Russell on Thursday, which has continued through on Friday and Monday. I was talking about this in the strategy session on Friday. So we just quickly go over to the NASDAQ. And so here, this is Thursday on the NASDAQ. So the NASDAQ had its fourth worst day of the year. It's not a big deal. It's just it's a down day, nothing more than that at this point. It's just a down day, but the size of it was might have been a couple of percent or something. So it was the fourth worst day of the year. But then on the same day, come over to the Russell, and it's had its best day since November 2014.
Yeah, wow. Jeez.
So it's best day in a decade. So this is coming back to that participation story, which I think is positive. This is why I think we want to go at this breakout, see what happens, see whether there's something else building. When I compress this Russell and just look at this, just getting a bit more data on it. There's our COVID lows. It's really got this big 18-month basing formation that the market now seems to be coming off. And then we've got this other, you can say, look, it started to rally off the October lows. Then we've got another platform which has been built over the last 6 months, which that seems to be breaking out from now. So I think this is an area of considerable potential. Everything's potential because things fail and things don't always follow through. But when you get the breakouts, I want to go at the breakouts, see where they go. If they go nowhere exciting, fine, just shut down the risk and move on. But if they do run, well, this is where the gains can come. So it's interesting times. So some good stuff going on, some good setups starting to appear in these markets, I think, Bronge.
All right. So they're the Australian and the US market. What about the Hong Kong market? Sort of the opposite.
Not so exciting. So this is the Hang Seng we're looking at. There's been some buying interest around the 100-day moving average. It's holding above support. There's support here around 17,000. The rallies just aren't getting any traction though, and it's also now been on the slide for 2 months. Just like a slow, gradual pullback of these strong gains we got through April and into May, but it's like just a 2-month grind lower. It's lost the momentum. I'd like to see some more. I would have liked to have seen some more stability come in before now. Like 4 weeks ago, if it started to stabilize and build a base, it would have been setting up nicely, but it hasn't done that. It just continued to get back gains. So look, for me, I don't think this is it could still gain momentum from here, but it just doesn't really have a standout setup at the moment. It's not a focus point for me right now. And the same goes for China. When we look at the Chinese market, it's now consolidating below the moving averages. Moving averages are also rolling over, so that brings in some vulnerability doesn't necessarily mean it's all going to break down, but it just doesn't have a happening setup at this point in time. It's lost that building structure that it had a couple of months ago when it got above the moving averages, got a nice rally back to the averages, rallied again, started to come back to the averages, and rather than start to hold the line, it started to give way, and now we're consolidating below the averages. So I prefer the setups we're seeing in things like the Russell, like the equal weight, like the ASX 200, some of the individual stocks in the local market. This just doesn't say this is something interesting building. Something could, but and we'll come back next week and the week after, and we'll keep looking at it, and we might get it at some point. I'm sure we'll get an interesting setup, but the stuff that looked like it was setting up a couple of months ago, it just hasn't been delivering. So it's then a case of, okay, well, let's just shift our focus to things that are showing potential at the present time.
Yeah, so just follow the momentum, just like the New South Wales Blues, Michael says. Now, before we get on to the first question from someone, well, let's have a quick look at the Indian market if possible. You can get exposure to that via ETFs on the Self Wealth platform as well. So let's have a quick look.
So where do I have that? I've got that here somewhere.
Nifty 50.
Here it is. This it here, I think. Yeah.
There's two. It might be two different ones. All right. Okay. Yep.
There are a couple of different ones.
We'll have a look at this one first. I don't
follow it closely, so I've got it here. I've got it like loaded into one of the things I have a look at, but I don't track it closely because it's not as simple to trade as some of the other markets for me. But this has been in a great trend. Look at this, going back to those COVID lows where it was around 25,000. Now we're up at 80,000. So it's been a standout market. It's been a tremendous trend. But as with every trend, there are the pullbacks along the way. That's why we use the wide trailing stops. But trend remains up. This was some election volatility that occurred. But there was quickly found buying support by the dip just below the moving averages, and now we're back trending above the averages. So if I was in this market, I'd be staying in. I'd be letting the profits run, and that's been a strategy that's worked well for several years.
Yeah, I was just looking at the other index that's over there in India. It's the Nifty 50, but it looks exactly the same, to be honest. So you just type in Nifty, looks exactly the same.
Yes, when I've traded futures on the Nifty a while back, and look, it's the same structure.
Yeah,
they're doing the same thing. Like it could be a bit like looking at the All Ordinaries and the ASX 200. I'm not sure, but they're pretty similar structures.
All right, fantastic. Well, they're looking good as well. If you didn't know that you can get exposure to these Indian markets via ETFs, both in Australia and America, if I just type in Nifty on that Self Wealth platform as well, right? So, let's have a look at our first question. Now, this is off the chat at the moment. It's coming through to me throughout the week. So it's a bit of I'll try and break it down. It's a bit of a loaded one from Michael here. We're currently, if we go back to the XJO or the ASX 200, I think ASX 200 is a similar thing.
Okay.
It's formed a symmetrical triangle. If there's a breakout to the top side of the triangle, wouldn't the whole structure then turn back into a rectangle trading range pattern, with the top of the triangle then becoming the resistance supply zone? So if there's a breakout, would it be better to buy the break of a triangle or the break of the top of the horizontal resistance? How would you manage risk if buying the break of the symmetrical triangle? Please discuss. Does that make sense to you, Jason, or do you want me to?
I'm not sure where we're getting the rectangular.
So basically, I think if it had stopped at that previous high from April, it would have formed a bit of a rectangle pattern. I'm assuming that's, but it didn't stop there, right? It broke right through that high of April. So how do we manage the risk around it having that symmetrical triangle now?
Look, the way I played this, I bought an ASX 200 ETF on, I think it was Thursday. So just when we started to break out, was it Thursday, Wednesday or Thursday? So it was just, I think it was probably Wednesday, maybe just as we were breaking out. And so the way I was looking at it was, look, it's buy early on the break and then put a stop loss back within the range. Like for me, I could look at the this low point from June. So back below that low point, the 50-day moving average. So I could look at that and say, let's say I was in around here. That can be done on, like, say, 2.5% of risk. That's the way I've been looking at it. That's from like trying to keep a tight rein on the risk. Like, there's nothing wrong with buying it and just saying, look, it's part of, I buy every month as part of my super account. I don't have a stop loss. You don't have to have a stop loss on everything, particularly when you're using an index ETF. You can do a long-term buy and hold. There's nothing wrong with that. But someone who wants to be somewhat active in their entries and manage that exposure a little closer, that's one way to do it. Like, buy the breakout, have the stop back inside the range. What I've seen people do over the years is they put their stop just too close within the range. I saw this a lot in the currency markets. People would do this. They'd track a range, get a breakout, and they'd put their stop loss just back inside the range. And so many times I'd see the market just come back over the next few days, come back within the range, clear out the stops, and then start to rally. So that's why I prefer to give it more room to move, and it's like set it back within maybe the middle of the range, get back below the 50-day moving average, or if you're on an hourly chart or whatever sorts of charts you're looking at, it's just coming back below moving average of relevance to the time period that you're looking at, and that's how I play it. Looking at it now, like this could conceivably, like over the next couple of weeks, we could see this come back, test back towards the breakout point, do a bit of work, and then start to rally again. Like, who knows how it's going to play out. But it has had a bit of a run and got a bit of an initial stretch above these moving averages. Quite often we do see the market then go sideways, the moving averages start to catch up, and then it sets up another opportunity to rally from. Probably not as enthusiastic to going out and buying today. Now we've had that initial run, I'd probably now like to see how it behaves now. Does it come back and find that support, like a real keen interest in buying the dip? What you don't want to see it to come straight back down as quickly as it went up. I don't think that will happen, but anything can happen. So for me now, it's like I want to watch how the structure develops. Now we've got the breakout. Does it start to hold on to those gains? A bit like in I just quickly zip away from stocks, just quickly like in the gold market. So we had a really big breakout in March in the gold market. The market rallied and now stretched above these averages, and now we've been the last 2 or 3 months we've just been traveling sideways, coming back to the moving averages, consolidating, and I think that then sets up the potential for the next rally. So, and this was a different type of range. It was more of a rectangular sort of range we're coming out of, but the same principles. Had the breakout, have a stop loss, maybe back below this low point from February, back below the 100-day moving average. Entry on the breakout, bit of a stop loss, giving it some room to come back and retest inside if that's what happens. Let it run, let it consolidate, look at the structure, and consider what to do next. So that's how I'm looking at the. That's how I'm looking at the ASX 200 now. Completely different markets, but price action is price action. That's how we can look at structures across markets we know nothing about, but you're just looking at that. Is there interest to buy on pullbacks? Where's the breakout? Is there follow through buying on a breakout? It's different markets, similar structures.
Yeah. Okay. All right. Let's get on some of these other questions now. So I'm a Motion Trader member, and I've been following your exit points to cut losses. However, unsure when should I take profits when a particular stock is still rallying, and DRO is a great stock that is really rallying right now. So,
yeah, and this is why I typically don't take profits, because like you don't know. No one knows how far a stock is going to rally. Like this is just. Like it's like maybe like you just don't know. Like you could have looked at rewind this a bit and go and so the motion traders buy signal was back here, back around, where was it? It was back around December, I think, at around 34 cents, thereabouts. And we've got an initial rally, then starts to pull back, and people think, a lot of people think, look, okay, I want to protect that gain. I'm going to take my profit, double my money. This is fantastic. I've doubled my money in 2 months. I'm cashing out. Problem when you do that is, what if it's rallying? Where's the top? Is at the top? Well, I don't know. Well, at the time, nobody knew. It was at the top, and now we're starting to come back and all back. So better lock in a profit now. Then it goes again. Now, does it look like it's getting a bit tired now? Maybe we should surely, we're up 300%. Surely we should lock this one in. Then it goes again. Is this the top? It's gone again. I don't know. No one knows where the top is. So a trend following approach is all about maximizing the gains from your best stocks. Your best stocks are the ones which are going to deliver the bulk of the portfolio's return. It's not just one stock. There might be, the best stocks might be your best 10%, your best 20%, like that 80-20 rule. So 20% of the stocks will provide 80% of the profitability over time. And so this is why we don't want to cap our upside potential by taking profits without good cause. And this is why I think so many portfolios struggle, because they're quick to take a modest profit. They'll lock in their 20s and 30s and 40%. But if you're always selling your stocks in that range, how do you get a stock that doubles? How do you get a stock like Drone Shields that might run 500%? And then you find if you're taking those profits, then they're just matching out your losses, which a lot of people let run. And then they end up with profits of 40% and losses of 70%. The whole thing doesn't work. You can see how mathematically they're just not going to have an outperforming portfolio. So we keep our losses relatively small. And when we get on a stock like Drone Shield, which doesn't come along, a stock like this might come along once every 2-3 years. So I'm on Drone Shield. I was on one similar called Calyx 3 years ago, and a couple of years before that, I was on one called Jumbo Interactive, and they're all 500% stocks. But there could be a few years in between, and then in between, maybe you've got a few stocks which are 100%, 200%, whatever it may be. But you want to really maximize your best ones. So that's why I don't use a take profit strategy. That said, and this is what I did I'll jump over to Jumbo Interactive. So some of my Motion Trader members will know this story. So I've actually got some markings on this chart. So this will help me. This is how I played it. So that's my entry point. The Motion Trader entry point was lower, but by the time I followed it, when I had available capital, this is where I got in around $2.70, and it ran and it ran and it ran. And every time you might have thought it was going to top, it went again, got up to $28. So it was 500% gain thereabouts. I think it would have been over that. It might have been 600-700% at the high. What happened with my portfolio is, because it had gone up so much, my initial purchase at the time might have been. I'm just guessing at the numbers now, but say I bought 5%. What would have been 5%? Probably not quite 5%. Maybe it's 2.5%. Maybe 2.5% of my capital went into this stock way back down here. But because it ran so much, that 2.5% exposure So my portfolio is just 2.5%, just nothing. But because it ran so much, my 2.5% exposure became 25%. So almost a quarter of the value of my portfolio mightn't have got that high, might have been 20%. Say 20% of the value of my portfolio was in one stock. And I didn't like that. So because my approach is many relatively small trades, not a few big ones. And this just became a big one just simply because it had gone up so much. So what I did was I scaled down. I sold a third of the position. You can see this green circle here. Sold a third of the position and then let the rest run until it hit the trailing stop. This was the trailing stop, closed out the rest. So I just took some money off the table, reduced, and what that did, it did cap the upside potential to an extent, but it left a lot of upside potential open, and it did reduce portfolio volatility, which can be a good thing to do at times. If the position becomes just too big, it's okay to prune it. Just cut it back a bit. That can be a sensible risk management strategy. Look at the benefit of using a trailing stop. Jumbo eventually came back. Yeah, it came back a long way. So I would have given it all back had I not had a trailing stop. But that's another thing altogether. Coming back over to Drone Shield, this has been an unbelievable trend. I don't know, is this a key reversal day we're getting at the moment where it's opened at a new high? Does it close at a low? There's so much excitement in this stock now, fear of missing out, all that sort of stuff driving it. It's one of those stocks which could come back. We could find this back at $1.80 in the next few weeks. And that just brings it back towards the moving averages. So I think I'm not doing this. It's not a large enough portion of my portfolio, but yeah, if it's a big chunk of someone's portfolio, I think considering do I prune a bit of it? Do I just scale out? That can be a good each way bet. So if it keeps going up, great. You're still on the field. You still got some players on the field. But if it does come back hard, you have taken some of the heat out of it at a higher level. So you give back a bit in what you continue to hold, but you've also locked some profit in as well. So it can be a good way to manage risk whilst keeping upside open.
Yeah. So, all right. So obviously a lot of people are taking profit today, probably, because you can see it's already down 40 cents. So just on this, to try and stop the loss of the capital that you've gained at the moment. Let's, for example, say that you bought it let's say the first motion trader signal, Jason, and you applied an ATR stop on it. What would it look like?
An ATR stop. Okay, well, let's put a 10 ATR on this. It's going to be wide. I can tell you now it will be a wide one because there's been so much volatility in the stock.
Maybe don't go too far back. Maybe just at the first breakout point wherever you.
No, that's where this is the first breakout back down here. Now I'm going to change the settings because it's on the default for this is tight. It's a 3 ATR. For those who don't know, an ATR is an average true range. So it measures it's basically the trading range. It gets to the average trading range over a period of time. So this is going over the last 2 weeks. What's the average trading range? And then you apply a multiple to that average. So I use a multiple of 10. This isn't the motion trader trailing stop. I vary this again. There's some other bits and pieces that go into it, which I think helps. But as a general guide, as a general overview of a wide trailing stop, this is round about where the motion trader stop would be. Comes in around the 100-day moving average. The 100-day moving average is a good approximation of a wide trailing stop, but I don't think it's as good as an ATR stop. We can go through that another time. I think ATR beats the 100-day moving average, but it's still a good measure. And people will say, "This is crazy. You're going to risk all this money. It's up at it's been up at $2.70, and you're going to let it come all the way back to $1.17." But this is how I've got myself in this position in the first place because I've given it lots of room to move. Like, look at these two pullbacks here. they're 30% plus pullbacks. So it's not reasonable to say with the look back in hindsight, it's not hindsight at the moment, but even now, it's not reasonable to say, oh, but you're going to risk giving back so much profit. But the only reason someone might be in this position, the only reason someone might have been able to buy at 34 cents and still be holding now is because they've given it move and they've given it enough room to see off to 30% plus pullbacks. So this is the everything's got a cost, everything's got a payback. The payback with the wide trailing stop is you give back money at the end. Now this trailing stop will probably continue to increase unless the stock just collapses in 2 days, which it probably won't. It could, but it probably won't. More often what you find is, like, if this were, say this was the peak, what could happen? You get a stock that falls, and then there's a buy the dip as people think it's going to go back to the previous high. Then it starts to stall. Then it starts to make its way lower, and the selling intensifies, and it makes its way down over a period of time. In which time the ATR stop has continued to grind up. And so, no, it's not getting out at the high, but it's probably getting out at a higher level than it currently is, because the stock doesn't usually just go from high to stop in one day. Can happen, anything can happen, but it probably doesn't. You don't see it that often. Looks more like that. So that's how that wide trailing stop looks. But you've got to hold nerve with a wide trailing stop. A lot of people can't hold their nerve with it, and that's why a lot of people don't get stocks like Jumbo or like Drone Shield, like Jumbo jumping back over to this. Like, could you have ridden that trend without a wide trailing stop? And the other standout for me through the motion trader process in the last few years was look at this, another stock which went a long way, had to see off some volatility. The wide trailing stop was able to do that. But look at the exit. You don't get out of the high, and that's okay. You got to, I'm happy to accept not getting out at the high if I can pick up a few 100% in between. People who think they're going to get out at the high, really, they're just not being genuine with themselves, because it doesn't work like that. And if you get out at the high once, it's luck, frankly. You can't rely on that as a strategy.
Yeah. All right. Well, I think you've answered probably a few people's questions in there around stop losses, to be honest, once again.
It's an area I get quite passionate about, because I know that's the secret to unlocking multi 100% gains. And I get a pushback from people quite often, and they'll say, your trailing stops are too wide. It doesn't work. It's like, well, I can show you stocks like Drone Shield all day, and I can show you the 30 to 40% pullback some of these stocks have on their way up. And you tell me, how do you stay on a 500% gain with pullbacks of 30% plus along the way unless you use a wide trailing stop? And you can't do it. It's that's just the nature of it. But it's and this is why a lot of people probably shouldn't trade individual stocks. They should buy an ASX 200 ETF and put it away for the longer term. It's individual stocks aren't easy because it's emotionally difficult to stay on big trends because of the pullbacks, because of the drawdowns along the way. It's process is simple, but applying it for a lot of people, it's hard. It's not a bad thing if you find it too hard, because most people do, I think. But if you really enjoy it and you're fascinated by the stock market, it's about like getting your head around the principles and understanding, why some things work. Why does a wide trailing stop work? Why is it so essential? If you want those big trends that come along every maybe 2 or 3 years, yeah, that's it, Rog.
Yeah, of course you can adjust the settings of the ATR if you wanted to lock in more of that profit and reduce the loss. But that's your choice, right? That's the system that you've got to create.
You can bring the trailing stop in closer, but you're going to get knocked out by by these 30% pullbacks. So people tell me this. I say, why don't we just use 15%? Because 15% gets you knocked out, 20% gets you knocked out, 25% gets you knocked out. Big trends will often have several pullbacks of, say, 15 to 35%. You can't, if you go, oh, look, I understand letting profits run and giving them room to move, but I only want to give them 20%. Well, okay, but just accept you're not going to get on too many stocks like Drone Shield because you're going to get knocked out along the way. It's just how it's. I don't make the rules. That's just what the market does. You've got to be able to see off corrections of between 15 and 35% typically to stay on some of these large trends. If you want to bring your stop in close, you're going to get knocked out of many of them. It's just how it is.
And Rob just said DRO is down because I bought. Yeah, well, that's yeah. There you go. I think that was funny.
And that's a bugger too, But so many times I've bought at the high and sold at the low. It's like, don't think like that. Don't think, oh, of course, it's just my luck. It happens to all of us. So many times, the number of times I've bought something at the high and sold it at the low, I'll tell you. But it doesn't matter. It's not you. Don't take it. The market gods are looking at you, and just it doesn't work like that. You follow a good process, good principles, and over time they're going to play out. And it happens to all of us. We all get these fills which we look at and go, oh, geez, that was ordinary. It just happens. It's okay. Don't worry.
Yeah, and look, with all the fundamentals going on around Drone Shield right now, I wouldn't be too afraid of it. Buying where it's going down at the moment, anyway. So, all right. So we've got another question here from a Motion Trader member. Can you just define a thinly traded stock? Can you please define
thinly traded
on volume or number of buyers and sellers? Well,
it could be both. If I look at a stock and it's got, it could be both. Like there may be a stock there. Say it's a $1 stock, and there are sellers at buyers and sellers at every level, but it's only for 100 shares here and 200 shares there. Well, there's lots of price points, but there's not much volume, so it's thinly traded. Say it's a $1 stock, and there's a million shares on the offer, but there's only one seller. Well, I'd say it's a thinly traded stock. Yeah, there's a lot of volume there, but it's just at one point. If that seller pulls the offer, well, there's no more. There's nothing else there. So people will define thinly traded differently. For me, I look at it and go, look, is this a stock which could get a bit, might take a bit of work to get out of, or even into? If 20 people want to go and buy it, is there sufficient volume there without the price moving too much? And I'll go, I'll put a thinly traded note on that. That's what I do in the daily signals. Sometimes I say, look, this stock is thinly traded, but it's a discretionary call on my part of what I'm seeing in the bid and offer. But everyone needs to make up their own mind about, look, what's thinly traded for me. Some people won't step outside the ASX 20 because everything else is too thinly traded. If you're a big fund, anything outside the ASX 50 might become like hard to move in and out of. So it's going to vary a bit for all of us.
Okay. All right. Let's start having a look at some tickers here. Let's have a look at SRZ, please. If we can find it, SRZ.
So let's just jump to a weekly quickly. So it's been hasn't done much for a while. Like is this like it's also like a 2-cent stock. But look, there's the possibility that there's like this is a base type of structure. It's just like some of these stocks, they just continue in this basing type structure for years and then fizzle out completely. But it's like it's not a stock for me. But that doesn't mean it's not going to do well, because there is like take the price column off it. Just look at it as price action. We've gone from below the moving averages to above. The averages have crossed. We're trading up alongside the averages. We've had a bit of a compression towards the averages, and we now seem to be rallying off it again. So there's some basic positive structure there. So then it's like, look, how would I manage risk? If I bought it today, where would I put my stop? You've got to give it a bit of room, this one probably. So you've got to get back below, I think, below the low from, where's that? The low from May, back below the 100-day moving average. So it was coming out around 40% stop loss. So it's a pretty significant stop loss. It's hard to do it much tighter than that. Like you could have one just below the 50-day moving average, so you get it maybe down to about 20%. But this could just like whip around like this, and then maybe break up. And if you have your stop loss, you set your stop loss just back below the 50-day, you could easily get taken out as it continues to go sideways and then rallies, and that's a bit frustrating. So that's why I say stop losses. To get it reasonably out of range of day-to-day volatility, it's really taking it below the 100-day moving average. So you're looking at like close to that 40% mark. So I'd probably maybe one play would be just to watch it, see if we do get more sideways, and then you buy the breakout from the sideways pattern, and then you can have a stop loss back within the range, like we were talking about early on about stops within ranges. That could work out. That could be a way to play it whilst really trying to keep a rein on that risk. Certainly has upside potential. Even just getting back to the top of its range, it's up. That's like almost 100% on where it is now. So it does have some asymmetric properties to it, in that the upside potential could be larger than the risk that would be applied. But it's a tricky one. Just because of the low price, it makes those percentages move around quite a bit when you're trying to manage the risk.
And what about USL?
Yeah, it's interesting with silver coming into play at the moment. So silver's looking pretty interesting. I'm assuming this is sometimes these stocks will have silver in the name, but they've changed what they've done and what they're doing a few times. But presuming there's some silver exposure in this, it's like the silver price is a plus. It's this is a bit like what we were just talking about with that previous stock, where we've come from below the average to above. We've had this longer consolidation, so you got the you really got the market moving within that box back to the moving averages, rallying off the moving averages, and we've got a breakout. So buying on the moving averages, you can sometimes have a closer stop. That would have worked in the previous stock as well, but it's above the averages at the moment. So that would have been a time to possibly think about buying it if someone really wanted to buy the dip. Alternatively, buy the breakout. And we just had a breakout, 2-3 days ago. Tricky now. You had to be on the ball to buy that breakout because it opened and then started to rally. So what do you do now? Can you buy it here? I think it's going to be the same situation as previously. The stop's going to be too big. Maybe not as big. It's a 22-cent stock, so it makes the percentages work a little bit better. Look, it could be bought at current prices with a 25% stop. That gets us back to the 50-day moving average. Upside potential, it could double. So 25% of risk, 100% potentially of upside, or more or less. Who knows where it goes? Could stall and come straight back. That's why we have the stop loss. But look, there's some. It's a structure which could continue to deliver. and there's a way to play it. So yeah, worth having a think about if there's something about that stock you like.
All right. Ross has said, with the 2 and 10-year Treasury yields dropping, will REITs become very sought after? Charts are suggesting GMG to start off with. GMG.
Well, this has just continued to run, hasn't it? It's just come back to the moving average. Trends certainly in place with this one. It's interesting. We spoke about this at some point in time. You can see I've got the. I would have been talking about a head and shoulders bottom at the time. We've got the shoulder, we've got the head, we've got the shoulder. Then we've got the breakout. Had the retest. This is what I was talking about earlier with the with breakout from ranges. Why I like to give it a bit more room than just having a stop just below, because you saw on this occasion it did come significantly into it. That could have even taken out a stop loss as well. Depends where you would have placed it. Like below a previous low is always, I like to have a stop. So I've had a stop here. Maybe this excursion to the downside could have been seen off, but any which way. Then it's run. So yeah, looks nice example of like looking back in hindsight with something we've looked at to see a basing structure, a breakout, and then ultimately a trend. And that trend remains in place. This is a hold. If someone likes it, it's buying into the strength. It could be a buy, stop loss below the 100-day moving average. It's run for a while. I don't like buying stocks which have been running for a while as much. It shouldn't matter because trend can go on for a long time. But my personal preference, I prefer trying to buy breakouts at lower levels. But that's just me. It's like getting in at a later level can still deliver a strong outcome.
What about INA? Is it a similar case? It's on the same question as well.
Well, I prefer the structure in this one because it looks like we've got the base. So there's different ways we could look at the base. Is it sort of like I don't know. I'd probably play around with it for a while to sort of work out the base. But look, we've certainly got the get our lower boundary so we can see we've got the basing structure there, and you can see it's a coiling structure as well. But you just can't neatly draw in a triangle because it doesn't work. You can't just like choose some lines you're going to use and some lines you're not. But you can generally see that compressing sort of pattern, even though it doesn't work for drawing a line on it so well. I like this moving average, how the moving averages have worked. So we've gone below to above, then we just oscillated as it's more ranging. You get another range in there. Then we start to lift out of that range and starting to gain that momentum. We're going sideways now along the moving averages, which are flat and breaking above it. So it's a sort of stock which, I could see it could continue higher. I just wonder at the moment, is it about to go now? Are we going to see sort of that, or are we going to see it pull back into the range a bit more and then go? So I don't know. But look, buying at current levels and maybe the stop just below the June low would potentially work. What's that? It's 10% of downside. What's our upside potential from this? We'll look back towards the highs, 35% or more. It's asymmetric to probably buy it now with a bit of a stop. But you got to, I think it requires a stop back below the 100-day moving average because it could pull back and do some work and then continue higher. So I think this would need a little bit of room if buying now. Otherwise, watch it, see if it can stabilize at current levels and then start to break upwards again. And then you're buying the breakout again.
All right. Let's have a look at ZIP, please. ZIP. Sorry.
Trend is up. If I was holding it, I'd keep holding it, let it run. It may well do a little bit of work here. Moving averages is still rising. It's gotten a bit stretched above the averages, so it could track sideways for a bit, let the averages catch up, and then run again. And that's one scenario. I probably wouldn't be in a hurry to buy it at the moment because it is pulling back. It could keep pulling back towards those averages. So I'd like at this stage, if I wasn't in it and I was looking at it, I'd want to see it stabilize and consolidate a bit, and then maybe buy the breakout, or perhaps buy the pullback to the averages and have a stop below that. But yeah, it's a stock which remains in an uptrend, and I'd want to hold and see where it goes, see if it can keep making positive headway over the months ahead.
All right. What about EHL?
Yeah, I like the structure of this. I actually got some of this myself recently, just as it was came up in my signals for my portfolio. Just buying the breakout, so you can. Just because I've got it doesn't mean it's a special setup, because I get plenty wrong as well. But I just have a tendency to keep those wrong ones not costing me too much. But when I get on one like Drone Shield, let it run. So yeah, look, that's a nice setup. Below the averages, above the averages, sideways back into the averages, and now another breakout. So it's a setup which could continue delivering. It's like this is a sort of setup which could see this stock back up towards $2, but it could also then just stall here and come back and trigger a stop loss. So it's got that asymmetric appeal. It's got I can see the upside potential. Doesn't mean the upside potential will be delivered upon, but the potential is there. So I want to stack my portfolio with stocks which have the potential to do great things. And I know most of them won't do great things, but I only need a few of them to deliver, and there I've got that big outperformance. And I can minimize the downside on the ones that don't deliver. And some that don't deliver might still go up 20, 30%. And they contribute. So yeah, that's how I like to try and build the portfolio. But yeah, this stock here, the overall structure, I think looks supportive of higher levels.
Okay. What about MSV?
Yeah, this is another one I've got in my portfolio. I've had it in there for a month or so. It hasn't done much since I got in. So initial motion trader signal was around April, I think, when the moving averages crossed, got a breakout. We've really just been traveling sideways. So there's a bit of a range really going on, a big range. So is it going to, and it keeps coming back to the averages and rebounding. So is it the case that, it could be the case that this is building up energy for a good punch higher? That's completely conceivable. And this is what I was just saying before. So I want to stack my portfolio with stocks like this, which could take off. But if they don't, that's okay. We've got a risk management strategy. So if this were to break down back below the 100-day moving average, well then it's probably starts becoming one to jettison. But it's some upside potential there at the moment.
All right. There's IRI.
I also suspect it's some sort of mutual services. I'm actually not sure what they do, which some people will think is a bit odd since I own it, but I don't know what most of my stocks do, because it's the price action I'm looking at, not the balance sheet.
Provision of drilling services to the mining industry.
Yeah, I figured it was something to do with the mining industry. And it seems to be a place of interest at the moment, with the way some of the commodities are performing. So it's one of those stocks which could be in a prospective sector that could, which may come alight, and that could contribute to the upside potential in it. So yeah, it's a story of interest. Yes, what was that other stock, Rog?
IRI.
Well, this one had a big run recently, and it's pushing up to a new high today. It's a motion trader stock. The signal was back down here in April. This is a great thing with momentum. It's just like, like you look at integrated, like there's no point looking at this for several years, like through 21, 22, 23. There's just nothing to see there. It's below the moving averages. It's not performing. And then just, and how quickly it can all change. Gets above the moving averages, compresses back towards them, has another little blip up, compresses back towards, and then whooshka, off it goes. But we had the early warning with the momentum. So this was the motion trader signal. Didn't get much early warning in it, but you don't need that much warning. It's just really a couple of weeks there, and then it was off. So this is the beauty of momentum. It just puts the spotlight on stocks to have a look at and consider and make a selection from. So I want to buy stocks which are setting up with that potential, rather than buying stocks hoping they're going to bottom out. Can I get below? And usually you can't. So forget that game. I'd go this side of the averages and try and get the big acceleration, which I usually won't get because most stocks don't do what we can see here. But as I keep saying, you only need a few, and that builds the outperformance. It's a hold. It's a let profits run. I struggle to buy it because it's like, look, it hasn't come back to the moving averages for a while since it started to break higher. It could, if someone was really keen, it could be bought at current levels. I guess a stop below the recent lows is 20% thereabouts. These moving averages should be higher. It's certainly still got plenty of upside potential. So yeah, look, it could be bought now, but just bearing in mind that it hasn't had a lengthy consolidation for a while and hasn't come back to the moving averages for a while. Now, stock can stay above the averages for some time, but ultimately they do come back, unless they get taken over, of course. So I'm happier letting it run. It could be bought at current levels, but just being aware that just manage your risk around it.
All right, we'll finish off with SKS, please. SKS.
No, this has been a fun one. I know a bit about, I've got this one in my portfolio, so that's how I knew it had been going up. This is an example of a thinly traded stock. When did I get in? I got in, I can't remember. The motion trader signal was probably back in December. I'm in somewhere in this region, December, January, February. It was thinly traded when I bought it, but it's technology, and technology's been running hot. So I thought, look, this is one of those ones which there's a bit of a story around it. That's why I was saying with Mitchell before, there's a bit of a story around it. So tech's on the go. There's a signal for a tech stock. It's not widely known. So I bought a stake. It's one of my best performing stocks at the moment. It's gone from, I don't know where I'm in. I mean, from 30 cents or something maybe. It's now up at $1.60. For me, it continues to be let profits run, not try and pick a top. Just see those, and it'll eventually come back and trigger my trailing stop. But yeah, let it run. Look, I couldn't buy it at this point just because it's stretched above the moving averages. Now, this can continue to run from current levels, and buying now could be a profitable entry point. But from managing my risk, is it asymmetric in that where do I put my stop? I just feel a little bit larger than I'd like it. So I probably wouldn't be buying it at this point, but I own it and I'm continuing to own it, and I have no thoughts of selling it or scaling down. It's up a lot, and I'm not thinking of scaling down because it's not 10% of my portfolio or 20% of my portfolio. So I'm not so concerned about the volatility it could cause if it came back quickly, as I was with that example we spoke about with Jumbo, where it was like 20% of my portfolio or something like that. So, for me, this is a nice one to let those profits run.
All right, fantastic. I think we'll leave it at that for today, Jason. It's funny because there's been a lot of talk about Drone Shield, and just at the start, we were pretty bullish on the market in general. I said, I had some great green days last week, and I think that Drone Shield single-handedly, just while we've been on this webinar, has been responsible for an opposite day compared to what I had last week. All right, so be careful out there in the markets with Drone Shield. That's for sure. I can say.
But it's interesting. Drone Shield is still above, from what I saw on the chart previously. It's still above where it closed on Friday. So on Friday, we'll be looking at going, wow, an all-time high. And now some people will be fretting about. I'm sure you're not fretting about it, Rog, because you know.
No, I'm just looking to go down.
Some people will be fretting about, oh, look, it was at an all-time high today, and now it's come back. This is terrible, but it's above where it closed on Friday. What's wrong? It's going great. Doesn't mean that maybe today's the top. We do not know. So this is why I talk about if the positions become so large that you can't sleep at night, then you consider strategies like scaling out. Nothing wrong with that. You don't need to get top dollar for every single share. It's a completely reasonable thing to do. So you got to work out what's best for you and play it accordingly. Each way bets. Nothing wrong with each way bets. Scale out a bit, doubles again. Well, you got out of some, but you still got some. But then you flip it the other way around and go, okay, well, it halves from here. Well, at least I got out some of it near the high. So, you're managing regret, and you got to think, look, how am I going to look back on this in hindsight if this happens or that happens? And you it does have to be all or nothing. You can scale it, and that can be a good way.
Yeah, we're not looking at it all. Shannon said go for a run and don't look at it, right? Because it is below Friday again. Friday's closed now, as we speak. That's how quickly things go up.
So
just as we speak, and we won't speak about it anymore. All right, let's finish up for today. Thanks, Jason, for your expertise. Thanks everyone for coming along and saying hello and giving us your tickers and questions. Fantastic. Feel free to pop any questions through to us. Feel free to go and check out Self Wealth if you're not a client already. Obviously, the brokerage is much better price than any bank. And then Jason's service over there at motiontrader.com.au. All right. We'd love to see you at either one of our services to say hello, and we're happy to answer any questions anytime. All right. Thanks, guys. Have a great day. And see you, Jason. We'll see you next week. All right.
Thanks, Rog. That's been great. Look forward to it.
All right.